Before we dive in, please remember that this video is for educational purposes only and is not financial advice. I am not a licensed financial advisor or insurance agent. The world of insurance is complex and varies by state and individual circumstances. Always consult with a qualified professional before making any financial decisions. You finally have it. That little laminated card with your slightly awkward photo on it. Your driver's license. The keys are in your hand. This isn't just a car. It's a declaration of independence. It's the freedom to go where you want when you want. It's late-night drives with friends, road trips you've only dreamed of. The simple joy of not having to ask for a ride anymore. You've saved up, you've found the perfect first car. And you are ready to hit the open road. And then you make the call to get auto insurance. And that feeling of pure freedom? It evaporates. It's replaced by a gut punch. The voice on the other end of the phone or the number on the website is so absurdly high it feels like a typo. $400 a month? $500? $600? For a 10-year-old Toyota? You start to wonder if they think you're insuring a Lamborghini. Suddenly, the dream of driving feels like a financial nightmare. You feel trapped, confused, and honestly a little ripped off. But what if I told you that feeling is by design? What if I told you that new drivers are systematically overcharged, falling into predictable traps that cost them hundreds, sometimes thousands of dollars every single year? And what if I told you there is a blueprint, a step-by-step system that allows you to sidestep these traps, uncover hidden discounts, and get the absolute best insurance rate possible, even with zero driving history? That's not just a promise. It's exactly what we are going to do in this video. This is your definitive guide to conquering the auto insurance game as a new driver in the USA. We're going to demystify the entire process. We're not going to give you lazy advice like, just shop around. We're going to show you how to shop, what to ask for, and how to build a profile that makes insurance companies see you not as a risk, but as a responsible customer they want to have. By the end of this, you'll know more than 99% of new drivers on the road. You'll understand how to pick the right coverages, how to demand every discount you're entitled to, and how to negotiate from a position of power, not desperation. First, you have to understand the battlefield. Why are you being quoted these insane numbers in the first place? It's simple. To an insurance company, you are a complete mystery. You are a black box. They have decades of data on experienced drivers. They know their driving habits, their accident history, their ticket history. They have a story. You have a blank page. And when an insurance company faces a blank page, they don't assume you're a safe, cautious driver who signals every turn. They assume you're a Grand Theft Auto character. They assume the worst-case scenario because statistically young, inexperienced drivers are the highest risk group on the road. It's not personal. It's a cold, hard business calculation based on data. They place you in the highest risk category by default, and that comes with the highest possible price tag. Your job starting right now is to give them reasons to pull you out of that category and put you into a cheaper one. And you do that by understanding exactly what factors they're using to judge you. There are 5 major factors that create your initial insurance rate. Let's break them down. First, and most obviously, is your age and driving experience. This is the one you have the least control over initially, but you need to understand it. Drivers under the age of 25, and particularly males under 25, are statistically involved in more accidents than any other group. The numbers don't lie, and insurance companies live and die by these numbers. So if you're 17, you're going to pay a lot more than a 37-year-old, period. But don't get discouraged. This is just the starting point. We're going to show you how to offset this factor with others you can control. The second factor is your location. Your zip code is a massive piece of your insurance puzzle. Where you live and park your car tells an insurer's story. Do you live in a dense urban area with high rates of traffic, theft, and vandalism? Or do you live in a quiet rural town where the biggest traffic jam is a tractor on a 2-lane road? This can swing your rate by 30% or more. They look at the number of claims filed in your specific area. They look at weather patterns. Is your area prone to hail or flooding? They even look at the quality of road maintenance. You can't just pack up and move for a cheaper insurance rate, but understanding this helps explain why a quote can seem so wildly different from a friend who lives just a few towns over. Third, and this is a huge one for new drivers, the car you drive. That sporty 2-door coupe with a powerful engine might look amazing, but to an insurer, it's a giant red flag that screams risk. They look at a few key things. The car's value. A more expensive car costs more to repair or replace. The car's safety ratings. Vehicles with better crash test scores and safety features like automatic emergency braking often get lower rates. And very importantly, they look at claims data for your specific model. Is your car a magnet for thieves? Is it statistically involved in more accidents? Does it have expensive, high-tech parts that cost a fortune to fix? A reliable four-door sedan with excellent safety ratings is an insurer's dream. A flashy sports car is their nightmare. Choosing your first car wisely is one of the most powerful moves you can make to control your insurance costs before you even ask for a quote. Fourth is the hidden factor most people don't even know about: your credit score. In almost every state, with a few exceptions like California, Hawaii, and Massachusetts, your credit score plays a major role in determining your premium. Insurers call it a credit-based insurance score. Their data suggests a strong correlation between how you manage your finances and how you manage your driving. People with high credit scores tend to file fewer claims. It might not seem fair, but it's the reality of the system. This is actually great news because it's a factor you can actively work on. Building a positive credit history, even as a young person, can directly translate into saving hundreds of dollars on your auto insurance. And the fifth factor is, of course, your driving record. As a new driver, your record is a blank slate, which, as we discussed, insurers see as a risk. Your immediate goal is to keep it that way. A single speeding ticket or at-fault accident in your first couple of years can be financially devastating. It confirms their bias that you are a high-risk driver and can cause your rates to skyrocket for 3 to 5 years. Protecting that clean record is your #1 priority. So age, location, vehicle, credit, and driving record. That is the formula. That is the lens through which every insurance company sees you. Right now, as a new driver, you might look at that list and feel like the deck is stacked against you. Young age, no driving history, maybe not much credit history. But don't, because now you understand the game. You see the battlefield. And every single one of these factors, except maybe your age, can be influenced. You can choose a car that insurers love. You can start building your credit. You can commit to keeping a spotless driving record. You are no longer in the dark. Understanding these elements is the first, most critical step. Now we can start building a strategy around them. We can turn these factors from liabilities into advantages. And the foundation for that strategy begins with understanding the core of the product itself. What are you actually buying? What do all those confusing terms like liability, collision, and comprehensive actually mean? And how much of each do you truly need? That's where we're going next. Let's break this down into plain English. Think of your auto insurance policy not as one single thing, but as a custom-built toolkit. You don't just buy a hammer. You buy a specific hammer for a specific job. Insurance is the same. You're bundling together different types of protection, and the three most important, the absolute bedrock of any policy, are liability, collision, and comprehensive. First up, and most important, is liability coverage. This is the one you absolutely cannot skip. In fact, in 49 out of 50 states, the law says you must have it. Why? Because liability coverage isn't for you. It's for everyone else. It pays for the damage you cause to other people and their property if an accident is your fault. It's your financial shield against a lawsuit. Liability itself is split into two critical parts. The first is bodily injury liability. Imagine you're running late, you glance at your phone for a split second, and you rear-end the car in front of you. The other driver gets whiplash and needs months of physical therapy. Your bodily injury coverage pays for their medical bills, covers their lost wages because they can't work. It even helps cover their pain and suffering. It protects you from having to pay for that person's recovery out of your own pocket, which could easily be tens or even hundreds of thousands of dollars. The second part is property damage liability. In that same accident, you didn't just injure the driver, you crumpled the back end of their brand new SUV. Your property damage coverage pays to repair or replace their vehicle. It's not just for cars either. If you swerve to miss a squirrel and take out someone's expensive brick mailbox and a prize-winning rose garden, property damage liability covers that too. Now, here's the single biggest mistake new drivers make. When you get a quote, you'll see a series of numbers like 25/50/25. This is insurance shorthand for your liability limits. That would mean your policy would pay up to $25,000 for bodily injury to one person, a maximum of $50,000 for bodily injury to everyone in the other car combined, and up to $25,000 for property damage. Every state has a legal minimum, and many people, especially new drivers trying to save money, just take the minimum. This is a catastrophic financial trap. Let's be brutally honest. $25,000 for property damage might have been enough in 1995. Today, the average price of a new car is over $47,000. If you cause an accident that totals someone's new Ford F-150 or a Tesla Model 3, your $25,000 in coverage runs out fast. And guess who's on the hook for the remaining $20,000, $30,000, or $40,000? You are. The other person's insurance company will pay to fix their car, and then their lawyers will come after you personally for the rest. They will sue you. They will get a judgment against you. They can garnish your future wages for years, even decades, to get that money back. Your first big paycheck could have a huge chunk taken out before you ever see it. The same goes for medical bills. One emergency room visit and an MRI can blow past a $25,000 bodily injury limit in a single afternoon. So what's the rule? Buy as much liability coverage as you can reasonably afford. Don't even consider the state minimum. A good starting point for a new driver is to look for a policy with at least 100/300/100 limits. That's $100,000 for one person's injuries, $300,000 total for injuries in an accident, and $100,000 for property damage. The difference in your monthly premium to go from the pathetic state minimum to a truly protective level of coverage is often less than you'd spend on coffee in a week. It is the cheapest, most important financial armor you will ever buy. Okay, so liability protects everyone else from your mistakes. But what about your car? If you cause that accident, your liability coverage does absolutely nothing to fix your own vehicle. That's where the second piece of the puzzle comes in: collision coverage. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it also covers you if you back into a pole, hit a guardrail, or run into a tree. The key thing to remember is that it typically covers damage when you are at fault. Now, collision coverage comes with a critical component called a deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company starts paying. They typically range from $250 to $2,000. Let's say you have a $500 deductible, and you cause an accident that results in $8,000 of damage to your car. You pay the first $500, and the insurance company pays the remaining $7,500. This is a trade-off. A higher deductible, like $1,000, means you're taking on more of the initial risk, so the insurance company will give you a lower monthly premium. A lower deductible, like $250, means you pay less if you have a claim, but your monthly premium will be higher. So what's the right choice for a new driver? Simple. Choose the highest deductible you could comfortably pay tomorrow in cash without going into debt or having a panic attack. If you don't have $1,000 saved up for an emergency, don't get a $1,000 deductible. Start with $500. It's a manageable amount for most people and keeps your premium reasonable. Do you need collision coverage? If you have a loan on your car or you're leasing it, the answer is yes. Your lender will absolutely require you to have it to protect their investment. If you own your car outright, say it's a 15-year-old Honda Civic worth $3,000, then it's optional. The rule of thumb is this: if you couldn't afford to write a check to buy a replacement car tomorrow, you need collision coverage. For nearly every new driver, it's a must-have. That brings us to the third pillar: comprehensive coverage. If collision is for hitting things, comprehensive is for pretty much everything else. Think of it as the weird stuff or acts of God coverage. It protects your car from damage not caused by a collision. What kind of weird stuff? A massive hailstorm that makes your car look like a golf ball. A deer that decides to jump in front of you on a dark road. A thief who steals your car overnight. A tree branch that snaps in a windstorm and crushes your roof. Vandalism. Fire. Flooding. Hitting an animal is one of the most common comprehensive claims, and it's a situation new drivers often get wrong. They assume it's a collision, but in the eyes of insurance, it's not. Just like collision, comprehensive coverage has a deductible that you choose. The same logic applies. Pick a deductible you can afford to pay out of pocket at a moment's notice. And just like collision, your lender will require it if you have a loan or lease. For a new driver with a car that's worth more than a few $1,000s, comprehensive is non-negotiable. The world is a chaotic place, and this coverage protects you from its randomness. So let's recap the foundation. Liability protects other people's bodies and property. Collision protects your car when you hit something. And comprehensive protects your car from theft, weather, animals, and other non-collision chaos. These three coverages form the skeleton of a strong insurance policy. Get the liability limits high, and choose deductibles for collision and comprehensive that you can actually afford to pay. But this is just the skeleton of your policy. What about your medical bills if you're hurt? What happens if someone who has no insurance hits you and you can't work for 6 months? These are the gaps that can still leave you financially ruined, even with the big three in place. And we're going to fill those gaps in the next part by talking about the optional coverages that can literally save you from bankruptcy. So let's talk about the first, and in my opinion, the most criminally underrated coverage you can buy: uninsured and underinsured motorist protection. Let's call it UM/UM. This isn't just an add-on. For many people, this is a financial life raft. Picture this: you're sitting at a red light minding your own business when bam, someone plows into the back of your car. Your neck snaps back, your brand new laptop on the passenger seat goes flying, and your rear bumper is now somewhere in your trunk. The other driver gets out, apologizes, but then drops the bomb: "I don't have insurance." Now what? Your car is wrecked. You have a potential whiplash injury that could mean weeks of physical therapy and medical bills. The other guy has no insurance to pay for any of it. He's what we call judgment proof. You can sue him, but you can't get blood from a stone. If he can't afford a $100 a month insurance premium, he definitely can't afford your $15,000 medical bill and $10,000 car repair. This is where uninsured motorist coverage swoops in like a superhero. It essentially lets you use your own insurance policy to cover your own injuries and damages, as if you were making a claim against the at-fault driver's policy that doesn't exist. It pays for your medical bills, your lost wages if you can't work, and your pain and suffering. And the underinsured part is just as important. Let's run that same scenario, but this time the guy who hit you does have insurance. The problem is, he bought the absolute bare minimum required by his state. Let's say his policy only covers $25,000 in bodily injury, but your medical bills after a hospital stay and a few surgeries balloon to $100,000. His insurance pays their $25,000 limit, and then they wash their hands of it. You are now personally on the hook for the remaining $75,000. Your life savings? Gone. Your future wages? Garnished. This is a nightmare scenario. But if you have underinsured motorist coverage, your own policy steps in to cover that $75,000 gap, up to the limits you selected. In some states, this coverage is mandatory, but in many it's optional. And drivers trying to save a buck will uncheck that box without a second thought. Please do not be that person. The Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured. That's a game of Russian roulette every time you merge onto the freeway. For the few extra dollars it costs per month, UM/UIM is the best bargain in the entire insurance industry. Okay, next up is a dynamic duo: medical payments coverage or MedPay and personal injury protection or PIP. They're similar but with a few key differences. Which one is available to you depends on what state you live in. Let's start with MedPay. Think of this as health insurance specifically for car accidents. It's relatively inexpensive and covers medical and funeral expenses for you and your passengers after an accident, regardless of who was at fault. That last part is the key. Remember how liability coverage only pays out after fault is determined, which can take weeks or even months of investigation. MedPay is immediate. You go to the emergency room, you get the bill, and MedPay helps pay it right away. It doesn't care if you caused the accident or if the other driver did. It's there to stop the immediate financial bleeding. It covers things like health insurance deductibles, co-pays, ambulance rides, dental work, and even chiropractic care. It's usually sold in smaller amounts like $1,000, $5,000, or $10,000, but it's an incredible safety net to have. Now, personal injury protection or PIP is like MedPay on steroids. If you live in a no-fault state, you're likely required to have it. Like MedPay, it covers your medical bills regardless of who's at fault. But PIP goes further. It also typically covers a percentage of your lost wages if you're unable to work because of your injuries. It can even cover essential services, like hiring someone to clean your house or take care of your kids if your injuries prevent you from doing so. It's designed to make you financially whole again after an accident, and it's a cornerstone of the no-fault system. So MedPay or PIP, whichever is offered in your state, you need it. It's the difference between getting medical care immediately or waiting for lawyers to argue for 6 months while collection agencies start calling. Let's shift gears from your body to your daily life. What happens when your car is in the shop for 2 weeks after that collision? How do you get to work? How do you take your kids to school? Taxis and Ubers add up fast. A rental car could cost you $50, $60, even $70 a day. Over 2 weeks, you could easily be out $1,000 just for a temporary vehicle. This is where rental reimbursement coverage comes in. For just a few dollars a month, your insurance company will pay for a rental car while yours is being repaired from a covered claim. Now, it's not a blank check. Your policy will have limits, usually shown as two numbers like 30/900. This means the policy will pay up to $30 per day, for a maximum of $900 total per claim. When you're buying it, look at the daily limit. Is $30 a day enough to rent a car in your area? Maybe you need to bump it up to $40 or $50 a day. Costs pennies to upgrade, but it makes a world of difference when you actually need to use it. Don't skip this. The first time you use it, it will have paid for itself for years to come. And what about those moments when you're not in a crash but you're just stuck? A flat tire on a busy interstate. A dead battery in an empty parking lot late at night. You run out of gas a mile from the nearest station. These things happen. And when they do, you have two choices. You can panic scroll through Google for a local tow truck company and prepare to pay an emergency call-out fee of $150 or more out of pocket, or you can have roadside assistance. Almost every insurance company offers this as a cheap add-on. For maybe $10 or $20 every 6 months, you get a 1-800 number to call for 24/7 help. They'll dispatch someone to change your tire, jump your battery, bring you a couple of gallons of gas, or tow you to the nearest mechanic if needed. It's peace of mind in a bottle. It turns a potential crisis into a minor inconvenience. Finally, I want to talk about one of the most important, yet most misunderstood, coverages for any new driver, especially if you're financing or leasing a new car. Gap insurance. When you drive a brand new car off the dealer's lot, it depreciates. It instantly loses a chunk of its value. After 1 year, your shiny new $30,000 car might only be worth $24,000. But here's the problem. You still owe the bank way more than that on your loan. Let's say you still owe $28,000. Now imagine you get into a serious accident and your car is declared a total loss. Your collision or comprehensive coverage will pay you what the car is worth at the time of the accident. That's the $24,000. But you still owe the bank $28,000. So the insurance company sends a check for $24,000 to your lender, and you are now responsible for paying the remaining $4,000. You have to write a check for $4,000 for a car that no longer exists. It is a brutal, financially devastating situation. This is the gap that gap insurance covers. It pays the difference between the actual cash value of your vehicle and the amount you still owe on your loan or lease. It's an absolute must-have if you're putting little to no money down on a new car. You can usually buy it from the dealership, but it's almost always cheaper to add it directly to your auto insurance policy. So now you know the pieces of the puzzle: liability, collision, comprehensive, UM/UIM, MedPay, rental, roadside, and gap. You've essentially built your perfect fortress of financial protection. But now you're staring at the final screen, and it's full of confusing numbers and sliders for things called limits and deductibles. And this is where most people make the biggest mistakes. Choosing the wrong numbers here can make even the best policy nearly useless when you actually need it. What's the difference between a $500 deductible and a $1,000 one? What do the numbers 100/300/50 actually mean? Getting this wrong can cost you everything, and that's exactly what we're going to break down step by step in the very next part. Let's start with the deductible. Think of it as your entry fee into a claim. It's the amount of money you have to pay out of your own pocket for a repair before your insurance company will pay a single dime. Let's make this real. Imagine you have a policy with a $1,000 deductible. One morning you're backing out of a tight parking spot, you misjudge the distance and crunch, you scrape your car against a concrete pillar. You take it to the body shop, and the mechanic gives you the bad news. The repair is going to cost $3,000. Because your deductible is $1,000, you write a check for that first grand. You pay it directly to the repair shop. Only after you've paid your part does the insurance company step in and cover the remaining $2,000. Now, what if you had a $500 deductible instead? Same accident, same $3,000 repair bill. In this case, you'd only pay the first $500. Your insurance company would then swoop in and cover the much larger chunk of $2,500. Sounds way better, right? A lower deductible means you pay less when an accident actually happens. So why wouldn't everyone just choose the lowest deductible possible, like $50 or $100? Because there's a catch. It's a fundamental trade-off, a seesaw of cost. A lower deductible means less financial pain after an accident, But it also means more financial pain every single month in the form of a higher premium. A higher deductible, like $1,000 or even $2,000, means you'll pay a lot more out of pocket if you crash, but your monthly insurance bill will be significantly lower. It's the classic pay me now or pay me later scenario. Insurance companies are rewarding you for taking on more of the initial risk yourself. They know that if you have a $1,000 deductible, you're probably not going to file a claim for a tiny $700 scratch, saving them administrative costs. But if you have a $200 deductible, you'll file a claim for almost anything. So how do you choose? This is one of the most important financial decisions a new driver can make, and here's the rule of thumb that can save you from disaster. Your deductible should never, ever be higher than what you have saved in a liquid, easily accessible emergency fund. Read that again. If you choose a $1,000 deductible to save $40 a month on your premium, you need to be able to write a check for $1,000 tomorrow morning without breaking a sweat, without selling something, and without going into credit card debt. If you can't, your deductible is too high. You're playing with fire. You're betting that you won't have an accident, and that is a bet that even the best drivers eventually lose. Be honest with yourself about your savings, and choose a deductible that protects you, not one that just gives you the cheapest possible monthly payment. Okay, that's your financial shield. Now let's talk about the sword. The part of your policy that protects you from the rest of the world when you are the one at fault. This is liability coverage, and it's represented by that confusing trio of numbers like 100/300/50. This isn't just jargon. This is the financial armor that stands between your life savings and a devastating lawsuit. Getting this wrong is how a simple fender bender turns into bankruptcy. Let's break down those three numbers. They always appear in the same order, and each one represents a different limit, measured in thousands of dollars. The first number is your bodily injury liability limit per person. This is the absolute maximum amount your insurance company will pay for the medical bills of any one single person you injure in an accident you cause. So if your number is 100, that's $100,000. If you hit a pedestrian and their hospital stay, surgery, and rehab costs $80,000, you're covered. But if their costs hit $110,000, your insurance pays the first $100,000, and guess who's getting a bill for the other $10,000? You are. The second number is your bodily injury liability limit per accident. This is the total maximum amount your insurance will pay for the medical bills of everyone involved in a single accident you cause, combined. If this number is 300, that's $300,000. Let's say you run a red light and hit a minivan with 4 people inside. Person A has $50,000 in medical bills. Person B has $70,000. Person C has $90,000. And person D has $60,000. The total is $270,000. Since that's under your $300,000 limit per accident, and each individual person's cost was under your $100,000 per person limit, you're fully covered. You walk away financially unharmed. The third number is your property damage liability limit. This is the maximum amount your insurance will pay to repair or replace any property you damage in an at-fault accident. This is usually someone else's car, but it could be a storefront, a guardrail, a fire hydrant, or a custom-built brick mailbox. If this number is 50, that's $50,000. So a 100/300/50 policy gives you up to $100,000 for one person's injuries, up to $300,000 total for everyone's injuries in the accident, and up to $50,000 to fix their damaged property. Now you might be thinking, okay, I get it, but my state only requires me to have something like 25/50/25. That's the legal minimum, so that should be enough, right? It's way cheaper. This is, without a doubt, the single most dangerous and financially catastrophic assumption a new driver can make. Let me paint you a picture. You decide to save a few bucks and go with your state's minimum 25/50/25 policy. You're a good driver, you're careful. But one day you're driving home from work. You're tired. You glance down at your phone for just 2 seconds to check a notification. In those 2 seconds, the car in front of you, a brand new Tesla Model Y, slams on its brakes. You don't have time to react. You rear-end it. It's not a high-speed crash, but the impact is solid. The driver of the Tesla and their passenger both get whiplash and need medical attention. The driver's bills come to $30,000. Your per-person bodily injury limit is only $25,000. Your insurance pays the $25,000, and suddenly you are personally on the hook for the other $5,000. The passenger's bills are $15,000, so you're covered there. The total medical bills are $45,000, which is under your $50,000 per accident limit, so you got lucky on that front. But now we have to deal with the car. That Tesla is packed with expensive sensors, batteries, and electronics. The repair estimate comes back, and it's a staggering $40,000. Your property damage limit is only $25,000. Your insurance company writes a check for $25,000 to the Tesla owner, and then their insurance company's lawyers turn their full attention to you. They sue you for the remaining $15,000. So, from a 2-second glance at your phone, you are now personally responsible for $5,000 in medical bills and $15,000 in property damage. That's a $20,000 bill that you have to pay. If you don't have it in savings, they can garnish your future wages. They can put a lien on your assets. Your financial life at 18, 19, or 20 years old is already in a massive hole. All to save maybe $30 a month. State minimums are a trap. They were often set decades ago, when a brand new car cost $5,000 and a hospital stay was a few hundred. In today's world of $80,000 SUVs and six-figure medical bills, carrying state minimum liability is like going into a sword fight armed with a plastic fork. It's legal, but it's not smart. So what's the right amount? For most drivers, a safe and responsible starting point is 100/300/100. 100,000 in property damage coverage is critical in a world where the average new car price is cresting $50,000. It's not uncommon to be involved in an accident with 2 or even 3 other vehicles, and those costs add up terrifyingly fast. The best part? The price difference between a dangerously low state minimum policy and a robust, protective 100/300/100 policy is often shockingly small. You might pay just a few $100s more per year for literally hundreds of thousands of dollars in extra protection. It is the single best value upgrade you can make to your policy. It's the move that lets you sleep at night, knowing that one small mistake won't ruin the rest of your life. Now you understand how to protect your wallet with a deductible, and how to protect your entire future with liability coverage. But we've only talked about covering the costs for other people. What about your own car? If you cause an accident, liability coverage does absolutely nothing to fix your vehicle. What happens if a tree limb falls on your hood during a storm, or you hit a deer on a country road, or your car is stolen from your apartment complex? For that, you need 2 other critical pieces of the puzzle: collision and comprehensive coverage. But are they always necessary? Is there a secret formula for when you should have them and when you should drop them to save a ton of money? That's exactly what we're breaking down next. So let's start with a simple image. Imagine your car insurance policy as a pizza. The liability coverage we just talked about? That's the dough in the sauce. It's the absolute, non-negotiable foundation. You can't have the pizza without it. Collision and comprehensive, on the other hand, are the toppings. They're what make the pizza truly satisfying and protect you from a bland, financially painful dinner. But like any topping, you have to decide if they're worth the extra cost. Let's demystify these 2 terms first, because they sound way more complicated than they are. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, or even a nasty pothole that wrecks your axle. Here's the key detail. It typically pays out regardless of who is at fault. If someone runs a red light and plows into you, their liability insurance should cover your car. But what if they're uninsured? Or what if you're the one who makes a mistake? What if you back into a post in a parking garage? That's where collision coverage becomes your hero. Without it, you're paying for those repairs entirely out of your own pocket. Now, comprehensive coverage. This is the everything else policy. Think of it as the acts of God and bad luck protection. It covers damage to your car from things other than a collision. We're talking about theft, vandalism, fire, falling objects like a tree branch, hail, floods, and hitting an animal like a deer. If you wake up one morning and your car is gone, or a hailstorm makes it look like a golf ball, comprehensive coverage is what you'll be calling on. Together, collision and comprehensive are often called full coverage, but that term is a bit of a myth. There's no single policy that covers absolutely everything. These 2 simply provide the most complete protection for the physical value of your own vehicle. Now the big question, do you actually need them? To answer that, let's tell a quick story about 2 new drivers, Sarah and Tom. Sarah just graduated from college and landed her first real job. To celebrate, she buys a brand new 3-year-old certified pre-owned SUV. It's a $25,000 car, and she financed it with a car loan from her bank. The bank, in its loan agreement, requires her to have both collision and comprehensive coverage, with a maximum deductible of $1,000. Why? Because until Sarah pays off that loan, the bank is the true owner of that car. That SUV is their $25,000 asset, and they are not about to let their investment get totaled in a wreck or stolen without a way to get their money back. If Sarah's car is destroyed, the insurance company will pay the bank first to cover the outstanding loan. For Sarah, the choice is made for her. If you have a loan or a lease on your car, you will almost certainly be required to carry both collision and comprehensive. It's not optional. But now let's look at Tom. Tom is also a new driver, but he's on a tighter budget. He saved up $4,000 and bought an older, reliable sedan with cash. Is his car free and clear? No bank, no loan. So when he calls to get insurance, the agent asks him, "Do you want to add collision and comprehensive?" For Tom, this is a real choice with serious financial consequences. Adding these two coverages would cost him an extra $600 a year. That's a lot of money when you're just starting out. Should he do it? This is where we get to the secret formula, which isn't so much a secret as it is a powerful rule of thumb that most people never learn. It's called the 10% rule. The rule is simple. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's current cash value, you should seriously consider dropping it. Let's do the math for Tom. His car is worth $4,000. The cost for the coverage is $600 a year. So we ask, is $600 more than 10% of $4,000? 10% of $4,000 is $400. Since $600 is more than $400, the 10% rule says Tom should probably drop the coverage. The logic behind this is powerful. Think about the best-case scenario for Tom if his car gets totaled. The insurance company would write him a check for the car's value, which is $4,000. But wait, he has to pay his deductible first. Let's say his deductible is $500. So the maximum payout he could ever get from the insurance company is $3,500. To get that protection, he's paying $600 every single year. In just a few years, he'll have paid a significant chunk of the car's value in premiums alone. He might be better off taking that $600 a year, putting it into a separate savings account, and self-insuring. If he has a fender bender, he can use that money to fix it. If nothing happens, the money is still his. But, and this is the most important part of this entire section, this formula comes with a giant asterisk. A huge warning label. The 10% rule only works if you can answer yes to one critical question. If my car were totaled tomorrow, could I afford to replace it without it causing a major financial crisis in my life? For Tom, his $4,000 car is his only way to get to his job. He has very little in savings. If he wrecks his car and doesn't have collision coverage, he can't get to work. He could lose his job. Suddenly, he has no car and no income. For him, a total loss would be catastrophic. In his situation, paying that $600 a year isn't just buying insurance for a car. It's buying job security. It's a safety net that guarantees he can stay on his feet, even if the worst happens. For Tom, the peace of mind is worth more than the $600. He should probably keep the coverage even if it violates the 10% rule. Now let's flip it. Imagine Tom had a $20,000 emergency fund saved up. In that case, losing his $4,000 car would be frustrating, but it wouldn't ruin him. He could go out and buy another one with cash from his savings. For that version of Tom, paying $600 a year to protect a $4,000 asset he can easily replace himself makes absolutely no sense. He should drop the coverage and pocket the savings. So the real formula isn't just about the car's value. It's about your financial stability. There's one more lever you can pull to make this coverage more affordable, and it's something most new drivers overlook: the deductible. The deductible is the amount you agree to pay out of pocket for a claim before the insurance company pays anything. Deductibles for collision and comprehensive typically range from $250 to $2,000 or more. Here's the simple golden rule. A higher deductible means a lower premium. A lower deductible means a higher premium. Insurance companies reward you for taking on more of the initial risk. When you get a quote, you might see that a policy with a $500 deductible costs, say, $80 a month. But if you raise that deductible to $1,000, the premium might drop to $60 a month. That's a savings of $240 a year. Over 5 years, that's $1,200 back in your pocket. The strategy here is to choose the highest deductible you can comfortably afford to pay on a moment's notice. Take an honest look at your emergency savings. If you have at least $1,000 set aside that you could use for a car repair tomorrow without breaking a sweat, then choosing a $1,000 deductible is a brilliant financial move. You get the protection you need against a catastrophic multi-thousand-dollar loss, but you get a guaranteed immediate discount on your monthly bill. You're making a smart trade-off, accepting a slightly higher risk for a definite reward. So let's bring it all together. Collision covers you when you hit something. Comprehensive covers you for almost everything else. If you have a loan or lease, you have no choice, you need them. If you own your car outright, use the 10% rule as a starting point, but let your personal emergency fund be the ultimate deciding factor. And no matter what, play with the deductible levels. Setting it to the highest amount you can comfortably afford is one of the fastest and easiest ways for a new driver to slash their insurance costs. Now that we've built our insurance pizza with the foundation of liability and the essential toppings of collision and comprehensive, you might think the recipe is complete. But there are a few specialty ingredients, optional coverages that most people either ignore or don't understand. Some are a waste of money, but a few of them, in the right situation, can be the most important part of your entire policy. And one of them, for certain drivers, is an absolute non-negotiable lifesaver. What is it, and are you one of those drivers? We're about to find out. That non-negotiable lifesaver is called gap insurance. And if you've just bought a new car with a loan, or you're leasing a car, this isn't an option. It's a necessity. Let me paint a picture for you. You've just driven your brand new $28,000 sedan off the lot. It's the first new car you've ever owned. The smell, the smooth ride, the feeling of accomplishment. It's incredible. You made a modest down payment, say $3,000, and you financed the other $25,000. You're responsible, so you got a great insurance policy with full coverage, liability, collision, and comprehensive. You feel completely protected. A month later, you're driving home from work. Someone runs a red light and T-bones you. The airbags deploy, the car is a wreck, but thankfully you're okay. Shaken but okay. The police report clearly shows the other driver was at fault. After a few weeks of back and forth, your insurance company declares your car a total loss. It's too damaged to be repaired. No problem, you think. That's what I have insurance for. They'll pay off my $25,000 loan, and I can start fresh. And that's when you get the call that turns your world upside down. The insurance adjuster informs you that the check they're cutting is for $22,000. You're confused. Wait, you say. I have a $25,000 loan. The car is only a month old. And the adjuster delivers the brutal truth of the auto market. The second you drove that new car off the lot, it depreciated. It lost value. In that first month, its actual cash value, what it's worth on the open market, dropped by $3,000. Insurance doesn't pay what you owe. It pays what the car was worth a second before the crash. So now you have a $22,000 check from the insurance company. You still have a $25,000 loan with the bank, and you have no car. You hand over the entire check to the bank, and you still owe them $3,000. You are literally paying for a pile of scrap metal that doesn't exist anymore. You have to keep making monthly payments on a ghost car, all while trying to scrape together another down payment for a replacement vehicle just to get to work. This is a financial nightmare, and it happens to people every single day. This is the gap between what your car is worth and what you still owe on your loan. And gap insurance is the simple, beautiful, and often inexpensive little add-on that covers that exact difference. With gap insurance, your provider would have paid the $22,000, and then the gap policy would have kicked in and paid the remaining $3,000 directly to the bank. Your loan would be zeroed out. You'd be free and clear to walk away and start over without a mountain of debt. If you are financing or leasing a new vehicle, especially with a small down payment, you are driving around with a ticking financial time bomb if you don't have this coverage. Ask your agent for it by name. Do not skip it. Okay, so that's the big one. But what about those other optional coverages? They're not all as dramatic as gap, but they solve some of the most common and most infuriating problems you'll face as a driver. Let's talk about roadside assistance. You've seen it offered everywhere. Maybe you even think it's a bit of a gimmick. It's not. Imagine it's 2 a.m. on a deserted highway and your tire blows out. Or you accidentally leave your lights on at the movie theater and your battery is dead. Or, in a moment of distraction, you lock your keys in the car. These things happen. Without roadside assistance, you're scrolling through your phone, frantically searching for a local tow company, wondering how much this emergency call is going to cost you. It could be $100, $200, or even more just for a tow or a jump start. With roadside assistance on your policy, you just call the number on your insurance card. They dispatch a local vetted professional to your location to tow you, change your tire, jump your battery, or even bring you a couple of gallons of gas if you run out. It's usually just a few extra dollars per month, and it buys you incredible peace of mind. Now a quick pro tip. Check if you already have this. Some new cars come with it for a few years, and some credit cards or cell phone plans even offer it as a perk. If you have AAA, you're also covered. Don't pay for it twice, but make sure you have it from somewhere. Next up is one of my personal favorites because it saves you from a massive headache: rental reimbursement. This is different from the liability coverage that pays for the other driver's rental car if you're at fault. This is for you. Let's go back to that accident scenario. Your car isn't totaled, but it needs significant repairs. The body shop says it's going to take 10 days to get the parts and fix it. How do you get to work? How do you get to class? Drop the kids at school? You need a car. Renting a car out of pocket, even a basic one, can cost you $50, $60, $70 a day. Over 10 days, you're looking at a $500 to $700 bill you didn't budget for. Rental reimbursement coverage solves this. For a very small premium, your policy will pay for a rental car while yours is being repaired after a covered claim. It's usually sold in tiers like $30/$900. This means it will pay up to $30 per day, for a maximum of $900 total per claim. You can usually buy higher limits like $50 a day, which is smart if you need a larger vehicle like an SUV. When you need it, this coverage feels less like insurance and more like a magic wand. Now for one that speaks directly to anyone who loves their car. Custom Parts and Equipment Coverage, or CPE. Your standard policy covers the car as it came from the factory. But what if you've upgraded it? What if you installed a $2,000 sound system? Or put on a set of $1,500 custom wheels and tires? Or added a special exhaust or a performance chip? If your car is stolen or totaled, your insurance company will value it based on the stock version. They will give you $0 for those thousands you invested in upgrades. All that money is just gone. CPE coverage is an add-on that specifically protects these modifications. You declare the value of your custom parts, and your policy is adjusted to cover them. If you've put any significant money into personalizing your ride, you absolutely need to ask about this. Otherwise, you're just throwing that investment away. Let's quickly touch on two more that are often confused but are very different: new car replacement and OEM endorsement. New car replacement is like the ultimate upgrade from Gap Insurance. If your brand new car gets totaled within the first year or two, the terms vary. This coverage doesn't just pay off your loan. It literally buys you a brand new car of the same make and model. It completely ignores depreciation. It's more expensive, but it's the ultimate protection for a new vehicle investment. Finally, the OEM endorsement. This is a secret weapon for people who care about how their car is repaired. OEM stands for Original Equipment Manufacturer. When you get into an accident, insurance companies often prefer that body shops use cheaper, aftermarket parts to save money. An OEM endorsement is a policy add-on that requires the shop to use parts made by your car's original manufacturer, the same quality parts that were on it when it was built. This can be critical for safety sensors, body panels, and ensuring your car drives and feels exactly like it did before the accident. It costs a little more, but it guarantees a higher quality repair. So, you see, these aren't just random money grabs. Each one of these coverages is a specific tool designed to solve a specific, and often costly, problem. Gap, roadside, rental, custom parts, new car replacement, OEM. They build a fortress of protection around you. But now you might be thinking, okay, I've got my liability, my collision, my comprehensive, and now I've added a few of these crucial extras. My premium must be heading for the stratosphere. How on earth can a new driver afford all of this? Well, this is where the game really begins. Because for every coverage that adds cost, there is a discount that can slash it right back down. And there are dozens of them. Some are obvious, but some are so hidden, your agent will almost never mention them unless you know the magic words to ask. And one of them, a simple 5-minute change you can make today, could cut your bill by as much as 25%. It's time to stop playing defense and start playing offense. The first magic word isn't a word at all. It's a question. When you're on the phone with an agent, you ask, "Tell me about your usage-based insurance program." Some call it telematics. Others call it a drive safe and save program. But it all means the same thing. You agree to let the insurance company monitor your driving, and in exchange they give you a massive discount. This is the 25%er. This is the game changer. And here's the secret. They want you to use it. They just can't offer it to everyone because frankly, most people are terrible drivers. They speed, they brake hard, they text at stoplights. For them, a monitoring program would send their rates through the roof. But you, as a new driver, are a blank slate. You're motivated to be safe. You're building your record from scratch. You are the perfect candidate. By asking for this program, you're not just asking for a discount. You're sending a powerful signal. You're telling them, I'm not a statistic. I'm a safe driver and I'm willing to prove it. Now pay me for it. So how does it work? It's simple. They'll either send you a tiny device you plug into your car's diagnostic port. It takes 10 seconds, or more commonly now, you'll just download an app on your smartphone. The app runs in the background and uses your phone sensors to track a few key things: hard braking, rapid acceleration, the time of day you drive, your total mileage, and this is the big one, any phone use while the car is moving. Now I know what you're thinking. I don't want Big Brother watching my every move. And that's a fair concern. But let's have a real conversation about it. Your phone right now is already tracking you. Google Maps knows your route to work. Your social media apps know where you check in. Your cell provider knows your location at all times. You are already giving away this data for free, and you're getting almost nothing in return. With a telematics program, you're not giving away any new data. You're just agreeing to sell the data you're already generating to a company that will pay you hundreds, maybe even thousands of dollars a year for it. It's a choice between privacy and price. For a new driver facing crippling premiums, saving over $1,000 a year is often worth letting an app know you don't slam on your brakes. Plus, there's a hidden benefit here that's even more valuable than the money. These apps gamify safe driving. They give you a score. You see a little dashboard showing you how you did on your last trip. And a strange thing happens, you start trying to beat your high score. You find yourself braking a little smoother, accelerating a little more gently, leaving your phone in your pocket. The app doesn't just save you money. It actively makes you a better, safer driver during the most critical period of your driving life. That's the home run. But playing offense is about scoring every chance you get. So let's load up your playbook with the other discounts they don't broadcast. When you get an agent on the phone, you're going to go down a checklist, and you're going to use specific language. First up, the good student discount. Don't just ask, do you have a student discount? The magic words are, what are your exact requirements for the good student discount? Most companies offer a significant discount, sometimes up to 15%, for students who maintain a B average or better. But some have different rules. Some extend it to recent graduates. Some offer it for being on the dean's list. You need to know their exact rules so you can provide the right proof like a transcript or a report card. Next, the defensive driving course discount. The magic words are, which specific state-approved defensive driving courses qualify for a premium reduction, and how long does that reduction last? Don't just take any online course. You need to take one they recognize. These courses cost maybe $20 or $30 and take a few hours online. But the discount they unlock can last for 3 years, saving you hundreds of dollars for a single afternoon of work. It's the highest return on investment you will ever find. Then there's the affinity discount. This is one of the best-kept secrets in the industry. Insurance companies partner with all sorts of organizations, universities, alumni associations, fraternities and sororities, certain employers, even credit unions. The magic words here are, can you please list all of the affinity groups, educational institutions, and professional organizations that you offer partnership discounts for? You might be shocked to find out that because your parents went to a certain college, or because you have an account at a specific credit union, you qualify for an extra 5 or 10% off. They will never think to ask you this. You have to bring it to them. Now for a huge one, the bundling discount. New drivers often think this doesn't apply to them. I don't own a home, so I can't bundle, right? Wrong. The magic words are, what is the percentage discount for bundling my auto policy with a renter's insurance policy? Listen closely because this is a pro-level hack. A renter's insurance policy is incredibly cheap. We're talking maybe $10 to $15 a month. It protects your stuff like your laptop and phone from theft or fire. But here's the trick. The discount you get on your auto insurance for bundling is often more than the entire cost of the renter's policy itself. You might pay $12 a month for renter's insurance, but it unlocks a $15 a month discount on your car insurance. You are literally getting paid $3 a month to have your belongings insured for free. It is financial insanity not to do this. These are the discounts. This is how you chip away at that premium. But playing offense also means being smart about the structure of your policy itself. 2 more key areas. your deductible and your coverage. First, your deductible. This is the amount of money you have to pay out of pocket before your insurance kicks in to fix your car after an accident that's your fault. Most people default to a $500 deductible, but you have a choice. You can raise it to $1,000 or even $1,500. The magic words to the agent are, "Can you quote me the premium difference between a $500 and a $1,000 collision deductible?" Every dollar you raise your deductible, you lower your monthly premium. This is a calculated risk. You are betting on yourself. You're saying, "I'm a safe driver. I'm not going to get into an accident, so I'd rather have guaranteed savings in my pocket every single month than have a lower bill if something goes wrong." For a new driver, saving an extra $30 or $40 a month by raising your deductible can make the difference between being able to afford insurance or not. That's almost $500 a year in guaranteed savings, in exchange for taking on a $500 risk. It's a smart bet. Finally, the most aggressive offensive move you can make, dropping coverage you don't need. Specifically, collision and comprehensive. Remember, liability coverage is the law. It pays for damage you do to other people. Collision and comprehensive pay to fix your car. If you're a new driver and your first car is a 10-year-old Honda Civic worth $3,000, does it make sense to pay an extra $800 a year for coverage that, after your $1,000 deductible, would only pay out a maximum of $2,000? Probably not. A good rule of thumb is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, it might be time to drop it. The magic words. Please provide a quote with only the state-mandated minimum liability coverage, and then a separate line item cost for adding comprehensive and collision. This forces them to show you exactly what you're paying for. Then you can look at that number, look at the value of your car, and make a smart, informed decision instead of just accepting a cookie-cutter policy. You take that $800 you were going to give the insurance company and you put it in a savings account. That becomes your self-insurance fund. This is what it means to play offense. You're not just a price taker anymore. You are a price maker. You are armed with the right questions, the secret discounts, and the strategic knowledge to build a policy that is tailored to you, not to their profit margins. You've learned how to prove you're a safe driver with telematics, how to claim every discount you're entitled to, and how to intelligently structure your coverage to eliminate waste. You now have the complete playbook. But knowing the plays is one thing. Executing them on the field is another. You can have all this knowledge, but it's useless if you don't know how to use it in the real world when you're actually shopping for quotes. And this is where most new drivers get completely overwhelmed and taken advantage of. They take this playbook and they walk right into the wrong store. The next step is the most critical of all. It's about how to take this arsenal of information and deploy it in the marketplace to force companies to compete for your business. It's about making one phone call that can save you $1,000. And I'm going to tell you exactly who to call and precisely what to say. The person you need to call isn't working in a massive soul-crushing call center for a billion-dollar corporation. They're not reading from a script designed to upsell you. The person you're going to call is a secret weapon, a professional ally in your corner. But before I tell you who they are, I need to tell you who they are not. This is critical, because most new drivers in a panic to get insured make the first and most expensive mistake right here. They pick up the phone and call what's known as a captive agent. You've seen their offices in strip malls all over America. A friendly face on a sign, a well-known logo, State Farm, Allstate, Farmers American Family. These are captive agents. The word captive is key. It means they are captured by and can only sell products from that one single company. Going to a State Farm agent and asking for the best possible insurance deal on the market is like walking into a Ford dealership and asking the salesperson to give you the absolute best price on a brand new Honda. They can't. They are legally and contractually forbidden from even mentioning another company's products, let alone selling them to you. They can only sell you Ford. They might have a few different models, a Focus, a Fusion, and F-150, which in insurance terms means a few different policy variations, but it's all coming from the same factory. They work for the insurance company, not for you. Their primary allegiance is to the brand on their business card. So when you, a new driver, walk in as a high-risk applicant, they have one tool in their toolbox: the rates their single company gives them for high-risk drivers. If that company happens to be particularly harsh on new drivers, you're stuck. The agent might be the nicest person in the world. They might genuinely want to help you, but their hands are tied. They can't check to see if Progressive or Travelers or Safeco might give you a rate that's 40% cheaper. They can only sell you what they've got. This is the default path. It's what most people do. And it's a trap. The person you are going to call is the exact opposite. You are going to call an independent insurance agent. This is the game changer. An independent agent is the secret weapon the big insurance companies hope you never find out about. Unlike a captive agent who works for one company, an independent agent is a broker. They work for you. Their allegiance is to their client, you. They aren't beholden to any single insurance carrier. Instead, they have appointments or contracts with dozens of different insurance companies, big national brands, smaller regional carriers, even specialty insurers you've never heard of. They are a one-stop shop for the entire market. Think of it this way. The captive agent is the Ford salesman. The independent agent is like an auto broker who can get you a price on the Ford, the Honda, the Toyota, the Chevy, and the Kia all with one conversation. They take your unique profile, your age, your car, your driving record, the coverages you need, and they submit it to their entire network of insurance companies all at once. The companies then compete against each other for your business, sending their best offers back to the agent. The agent then acts as your personal advisor, sitting down with you to compare the top 3 or 4 offers side by side. They can tell you, okay, Progressive came in cheapest, but for $30 more, Travelers is giving you a much lower deductible and includes rental car reimbursement. Based on your situation, I think the Travelers policy is the better value. This is an insane advantage, especially for a new driver. Why? Because as we've established, insurance companies view you as a giant question mark. Some companies will see your lack of experience and immediately place you in a high-risk, high-cost category. But other companies might have a different algorithm. Maybe they have a new program specifically designed to attract younger drivers. Maybe they weigh good student discounts more heavily. Maybe a smaller, regional carrier is trying to expand its market share in your state and is being super aggressive with its pricing to attract new clients. You would never find these deals on your own. You could spend 40 hours filling out online forms and still miss the one niche company that's perfect for you. But an independent agent knows the landscape. It's their full-time job to know which companies are friendly to new drivers and which ones to avoid. They are your market expert, your negotiator, and your advocate, all rolled into one. And the best part? Their service is completely free to you. They get paid a commission by the insurance company you ultimately choose, and that commission is already built into the price of the policy, regardless of how you buy it. So you get all of this expert help, all of this market access for absolutely no extra cost. So how do you find one of these champions? It's simple. You don't need a secret handshake. The easiest way is to go to Google and search for Independent Auto Insurance Agent near me. Look for agencies that explicitly state they represent multiple companies. A great national resource is the website for the Independent Insurance Agents and Brokers of America, also known as the Big I. Their site has a locator tool to find a trusted, vetted agent in your zip code. Look at reviews. Find an agent or an agency that has a lot of positive feedback specifically about being helpful and finding great rates. You're looking for a partner. Once you've found a few promising candidates, you're ready to make the call. This is where you deploy the information we've been gathering. You are not going to call sounding like a lost teenager. You are going to call sounding like a prepared, informed consumer who knows exactly what they want. You're going to command respect and get the best possible service. Here's your script. You can do this over the phone or in an email. Take a deep breath. You've got this. You'll start with a powerful opening that immediately frames the conversation. Say this: "Hi, my name is," your name. "I'm a newly licensed driver, and I'm looking for an independent agent to help me shop for my first auto insurance policy. I was hoping you could help me with that." Simple. Direct. You've established who you are, what you want, and that you specifically sought them out because they are independent. This tells them you've done your homework. Next, you will demonstrate your preparation. They'll ask for your information, and you'll be ready. You'll say, "Great. I have all of my information ready for you. I have my driver's license number, the vehicle identification number for my car, which is a year, make, model, and the address where it will be garaged. I've also already decided on the liability coverage I need, which is," mention your 100/300/100 or 250/500/250 limits. "I'd also like quotes for comprehensive and collision coverage with a $1,000 deductible." Boom. In 30 seconds, you have just communicated that you are the most prepared new driver they will speak to all month. You're not wasting their time. You know what you need. This flips a switch in their brain. They will take you seriously. Now, for the most important part, you will give them their mission. You will use a key phrase that tells them you are focused on value, not just the rock bottom price. Say this: "My primary goal is to find the best possible value," which to me means the most comprehensive coverage for the most competitive premium. I'd like you to shop my profile with all the carriers you work with, paying special attention to any that are particularly favorable to new drivers in our state. You've just told them exactly how to succeed for you. You've defined value, and you've specifically asked them to use their expert insider knowledge about which companies are best for someone in your exact situation. Finally, you set the expectation for the follow-up. Don't just leave it open-ended. Say, "Could you please get back to me with the top 3 quotes you find? I'd like to see them broken down by coverage and annual premium, and I'd love for you to briefly explain the key differences or advantages of each one." And that's it. You hang up the phone. You've just unleashed a seasoned professional to do all the heavy lifting for you. You've leveraged their relationships, their software, and their expertise to force a dozen or more companies to fight for your business. You've spent 15 minutes on one phone call that will do more for you than 15 hours of mind-numbing online research. That agent will now go to work. And in a day or two, your inbox will have a handful of curated, competitive quotes. But getting the quotes is only half the battle. The insurance companies have one last trick up their sleeve: a final shell game hidden in the fine print and confusing jargon of those policy documents. And in the next part, I'll show you exactly how to read a quote, how to spot the hidden traps, and how to make sure the policy you choose doesn't have a gaping hole in it, right where you need the coverage most. Alright, let's pull back the curtain. You've got a stack of quotes in your email, or maybe a few tabs open on your browser. It's just a scramble of numbers, industry terms, and a big scary price at the bottom. Your first instinct might be to just pick the cheapest one and be done with it. That is the single biggest mistake a new driver can make. That cheap quote could be a financial time bomb. So let's defuse it. We're going to dissect one of these quotes together line by line so you know exactly what you're paying for, and more importantly, what you're not. First, find the declarations page. Think of this as the receipt for your insurance policy. It's the one-page summary of everything. Who is insured, what cars are covered, what coverages you've selected, and how much it all costs. This is your command center. At the top, you'll see the policy period, usually 6 or 12 months, and the total premium for that period. Let's say it's a 6-month policy for $900. Below that, they'll often show a monthly payment option like $150 a month. Be careful here. Sometimes paying monthly includes small installment fees, meaning you actually pay more over the 6 months than if you paid it all up front. It's not a huge deal, but it's something to be aware of. Now for the most important section, the coverages. This is where the real story is told. It's usually broken down into a few key parts. The first, and the most critical for your legal and financial survival, is liability. This is the coverage that pays for the damage you do to other people and their property. It won't pay a single penny for your own car or your own injuries. This is for the mess you create. You'll see it written as 3 numbers separated by slashes, like 25/50/25. This looks like a secret code, but it's simple once you know the key. The first number is the bodily injury liability limit per person. In our 25/50/25 example, it means your insurance will pay up to $25,000 for a single person's medical bills in an accident you cause. The second number is the bodily injury liability limit per accident. The 50 means your policy will pay a maximum of $50,000 total for all injuries in that one accident, no matter how many people are hurt. The third number is the property damage liability limit. The 25 means your policy will pay up to $25,000 to repair or replace whatever property you damaged, which is usually the other person's car. Now here is hidden trap number 1, the state minimum deduction. Many states only require you to carry these low 25/50/25 limits, or something similarly small. The insurance comparison sites will happily sell you a dirt cheap policy with just these minimums. Feels like a win. It's a catastrophe waiting to happen. Think about it. $25,000 for property damage. What happens when you slide on some ice and hit a brand new $40,000 SUV? Your insurance pays the first $25,000, and then they turn to you for the remaining $15,000. What about medical bills? A multi-day hospital stay with surgery can easily exceed $50,000. If you cause a crash that seriously injures 2 people, that $50,000 limit could be gone in an instant. And then they come for you. They can garnish your wages, put a lien on your property, and financially haunt you for years. State minimum coverage is not protection. It's a gamble with your entire financial future. I strongly recommend getting limits of at least 100/300/100 if you can possibly afford it. The price difference per month is often less than a few pizzas, but the difference in protection is life-changing. Next on the quote, you'll see uninsured and underinsured motorist coverage, or UM/UIM. This is your shield. This protects you when you get hit by someone who has no insurance or not enough insurance to cover your bills. 1 in 8 drivers in the US is uninsured. You need this. A good rule of thumb is to have your UM/UIM limits match your liability limits. If you think your own injuries are worth $100,000 in coverage, you should have the same amount to protect you from someone else. Now we get to the part that covers your car. This is usually listed as physical damage, and it's broken into 2 parts: collision and comprehensive. Collision is exactly what it sounds like. It pays to fix your car if you collide with another object, be it another car, a guardrail, or a tree. It doesn't matter who was at fault. Comprehensive covers almost everything else. Think of it as acts of God or non-collision events: theft, vandalism, fire, hail, flooding, or hitting a deer. Next to both collision and comprehensive, you'll see a dollar amount listed as the deductible. This is hidden trap number 2, the deductible deception. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a dime. So if you have a $500 collision deductible and you cause $4,000 of damage to your car, you pay the first $500 and the insurance company pays the remaining $3,500. Here's the trap. To make a premium look tantalizingly low, a quote might have a very high deductible, like $1,000 or even $2,000. A higher deductible always means a lower premium, but you have to ask yourself a brutally honest question. If I wreck my car tomorrow, do I have $2,000 in cash right now to hand to the body shop? If the answer is no, then that deductible is too high, and that cheap policy is a fantasy. Choose a deductible you can comfortably afford to pay on your worst day. For most people, $500 is a good starting point. Finally, look for the smaller optional coverages. These are often where you find immense value for just a few extra dollars a month. Rental reimbursement is a big one. If your car is in the shop for 2 weeks after an accident, this coverage pays for a rental car. Without it, you're out of luck. Roadside assistance is another. For a couple of bucks a month, it covers towing, jump starts, and flat tires. It's cheap peace of mind. If you have a loan on your car, you absolutely must look for gap insurance. If you total your brand new car, the insurance company will only pay you what the car is worth today, which might be less than what you still owe on your loan. Gap insurance pays that difference, so you're not stuck making payments on a car that doesn't exist anymore. So now you know how to read the menu. The final step is to compare your quotes properly. Don't just look at the price. You have to compare apples to apples. Open a spreadsheet or get a piece of paper. Create rows for each coverage: bodily injury liability, property damage, collision deductible, comprehensive deductible, rental reimbursement, and so on. Then create a column for each insurance company. Go through each quote and fill in the numbers. Now you can see the truth. That quote that was $50 cheaper? It probably has state minimum liability, no rental coverage, and a deductible so high you could never afford to use it. The slightly more expensive quote might have 5 times the liability protection and a manageable deductible. By lining them up this way, you're no longer comparing price. You're comparing value and protection. You're making an informed decision, not just a cheap one. You've decoded the jargon, you've spotted the traps, you've lined up your options like a pro. You've found the policy that gives you the best protection for the best price. You are 99% of the way there, ready to click buy. But stop. There is one final move the pros use. A last-minute check that can save you a surprising amount of money and uncover discounts you didn't even know existed. It all comes down to asking 3 very specific questions before you hand over your credit card number. And in our final part, I'm going to give you those exact word-for-word questions that will complete your journey from a new driver to an auto insurance expert. Alright, get ready to write these down, screenshot them, tattoo them on your arm, whatever you have to do. Because these are the 3 questions that separate the amateurs from the experts. They are designed to cut through the sales pitch and get to the heart of what you're actually buying. A promise. The first question you need to ask is the ultimate stress test. After they've given you the final quote and you're about to say yes, you look them in the eye, or you say very clearly over the phone and you ask this: let's pretend for a moment that 5 minutes after I hang up this phone, I'm involved in a moderate at-fault collision. Can you walk me through step by step the entire process from my very first phone call to you, to the moment the claim is fully paid and closed. And then you stay silent. You let them talk. What you're doing here is brilliant. You're not asking if they have a claims department. You're not asking for a phone number. You are forcing them to mentally rehearse the worst day of your driving life. You are testing their knowledge, their confidence, and the company's internal process right then and there. A bad answer sounds vague. It sounds like, oh, you just call the 1-800 number, and they'll take care of it. Or, you'd file the claim on the app. That's not an answer. That's a deflection. It tells you that this agent is a salesperson, and once the sale is done, you're just a number in a queue. A good answer sounds like this. Okay, great question. First, make sure you're safe and call the police to file a report. Then you'll call our 24/7 claims line. That number is right on your insurance card. You'll be assigned a specific claims adjuster within 12 hours, and they will be your single point of contact. They'll first arrange for a tow truck if needed and help you set up a rental car, which your policy covers up to $35 a day. Then they'll schedule an appraiser to look at your vehicle within 48 hours, either in person or through photo submission. Once the estimate is approved, we can either pay the body shop directly, or we can send the check to you. Your deductible would be paid directly to the shop. The whole process for a moderate claim typically takes between 9 and 14 days to resolve. Do you see the difference? It's night and day. One is a vague promise. The other is a plan of action. The agent who can give you that detailed answer isn't just selling you a policy. They're showing you a roadmap out of a crisis. That's who you want on your side when you're standing on the side of a highway, shaken and confused. That answer is worth more than a $10 a month discount, I promise you that. Now for the second question. This one is about the future. It's about protecting yourself from the dreaded premium creep, where your rate slowly and mysteriously goes up every 6 months, even when you've done nothing wrong. The question is this. Aside from me getting into an at-fault accident or receiving a traffic ticket, what are all the other potential reasons my premium could increase at my next renewal in 6 months? This question is a polite but firm way of asking, where are the hidden costs? You're forcing them to be transparent about the things most companies hope you won't notice. A rookie agent might get flustered. They might say, oh, your rate is locked in for 6 months. But you know better. What you're listening for are the industry insider terms. A great, honest agent will say something like, well, your rate for your driving record is stable, but there are a few things that can change it. We sometimes have general rate adjustments across the state based on repair costs and accident frequency in your area. So if the cost of car parts in your zip code goes up, that could cause a small increase for everyone. Also, the quote I've given you includes a new customer discount of 15%, which will be removed after the first 2 terms or 1 year. But by then, you'll be eligible for our claims-free renewal discount, which should offset most of that. Boom. That is pure gold. They've just told you about statewide rate adjustments, the impact of your zip code, and most importantly, they've been upfront about a temporary discount that's going to disappear. They've given you a peek behind the curtain. An agent who tells you this is respecting you as an intelligent customer. They aren't trying to hook you with a low introductory rate, only to jack it up a year later, hoping you're too busy to notice or switch. This question helps you budget for the long term and exposes the companies that rely on that sneaky loyalty tax to make their money. Okay, this brings us to our third and final question. This is the one that makes sure you are not leaving a single dollar on the table. It's the ultimate discount double check. Don't just ask, am I getting all the discounts? That's a lazy question that gets a lazy answer. Instead, you need to be precise. You ask, I want to make sure we've gotten the absolute best rate possible. Could you please list out by name every single discount that has been applied to this final quote? And then, could you tell me if there are any other discounts I might become eligible for in the next 6 to 12 months? This is a 2-part killer question. The first part forces accountability. It makes the agent go through your file and actively confirm what's there. They can't just say, yep, they're all in there. They have to say, okay, I see the good student discount, the multi-policy discount because of your renter's insurance, the e-pay discount for automatic billing, and the paid-in-full discount. Hearing them listed out gives you confidence and confirms they've done their job. You might even hear a discount and say, wait, what's that one? And discover something new. But it's the second part of the question that's the real pro move. Any other discounts I might become eligible for? This shifts the conversation from the present to the future. It prompts the agent to become your financial advisor, not just a salesperson. A great agent will respond, that's a great question. I see you're 20 right now. When you turn 21, we can add the mature driver discount, which will save you another 5%. Also, if you take an approved defensive driving course online anytime in the next year, just send us the certificate and we'll add another 10% discount midterm. And finally, if you go 3 years without a claim with us, you'll automatically be enrolled in our accident forgiveness program. Look at what you just accomplished. You've not only maximized your savings for today, but you've also created a roadmap for saving even more money tomorrow. You've turned the insurance agent into a partner in your financial success. So there they are. 3 simple, powerful questions that will transform your insurance buying experience. One about the process, one about the price, and one about the potential. And with that, you've done it. You have completed the journey. Think about where you were when you started this series. Maybe the words liability and deductible were just confusing jargon. Maybe the idea of comparing quotes felt overwhelming, like a mountain too high to climb. But not anymore. Now you understand coverages. You know how to set your limits. You know where to shop, how to compare apples to apples, and how to spot a red flag a mile away. And now you know the 3 secret questions to ask that put you in the driver's seat of the negotiation. You are no longer just a new driver at the mercy of a complicated system. You are an informed, empowered consumer. You hold the knowledge, you hold the power, and you are fully equipped to make one of the most important financial decisions of your young adult life. Not with fear, but with total and complete confidence. Your first major decision as a driver isn't just about the car you choose. It's about how you choose to protect yourself, your future, and everything you're going to work for. You now have the complete blueprint to do it right. So go out there, get those quotes, ask your questions, and drive forward with the one thing no policy can ever list on a declarations page: true peace of mind. Drive safe.